Welcome to the Chinchilla Pickin' Podcast. It is March 31st, 2022. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and I am here with Brandon Beaver. Brandon, how are you doing, man?
We want everybody to make money, even the apes who think they're apes, but they're just pigs lining up to the slaughterhouse. You told me I can't talk about this, but I'm doing it anyway.
And here you are. Here you are going. Yes. Well, I mean, they're enthusiastic. They brought a whole new group of people to retail investing, and they shone a very, very big spotlight on the retail investing world. And it wasn't always in the best way, you know. I mean, there's retail investors like you and I. Then there's retail investors who like throwing $1,000, whatever is the cool stock of the moment.
The original plan here was to force short squeezes on stocks that had high short interest and try to screw over the very people who have been screwing over retail investors for years. And I was very happy about that.
So was I. I was excited about that.
Now it's turned into buy and hold because we believe in the turnaround, and Ryan Cohen's on the board, and whatever. My God,
you know. Hey, we'll touch base on this later about that.
$12 billion for a company that's losing a ton of money.
Okay, yeah, we're gonna touch base on that here in a little bit. All right. So if you're listening right now, we will touch base on that. Our goal is always, guys, if you're listening to us right now, we want to educate you guys. That's part of what we say in our little motto there: entertaining, education, and uplifting. So we cover these stories, we cover these things, we try to explain how we get to our decisions so that you can learn and you can do this yourself. That's the end goal, to teach you guys how to be good, responsible traders, grow your income, grow your money. And we have to be a little bit funny at times between Brandon and I jabbing at each other. So, I mean, that's part of the fun of the show. If you like it, if you like what you're hearing and you like how we're doing it, please go ahead and hit subscribe and leave a review on whatever service you use, and whether it's Spotify, just Google, Anchor FM, whatever it is. We appreciate that. That's how we organically grow, and that's how we move up in the rankings. And we love to do this. We would do it if only one person listened. So we're always going to be here. We're always going to do this. You know, Brandon, look like you want to say something.
What a weird couple of years. We've had the pandemic, and now you've been paying attention to Jim Cramer. Jim Cramer's been at war with the apes on Twitter, trying to tell them to sell their stocks. And there's been a pandemic. That Russia is invading Ukraine. We're back in a Cold War again. Will Smith is smacking Chris Rock, and I am defending Jim Cramer. What is happening?
I don't know. Yeah, I've never thought I would see the day you defend Jim Cramer, but it happens, man. It happens. All right, let's get into the show, guys, because it seems like we want to get talking about these things right away. So rules. Brandon and I get together 5 to 10 minutes before the show. We tell each other what we're going to talk about. We save the live discussion for you here on the show. That way you can get our honest opinions and honest back and forth, and it's not scripted. That way it feels more natural. All right, so Brandon, we're going to let you lead it off. I know I'm going to have a few questions and interruptions as you go, because you mentioned your topics and I already have questions for you, but go ahead.
Bonds are dead. Does that sound familiar?
Yeah, I think last year at this time you said
bonds
that, didn't you?
Dead. I told you not to go long on bonds last year because bonds are dead. Recently, Deutsche Bank, is that right? Am I saying it right?
It's close enough, man. Yeah. It's Deutsche.
There's a report from the head of the thematic research of this bank that says that U.S. government bonds are about to complete one of their worst quarters for total returns in the past 157 years. This is data stretching back to the Civil War. Thursday will mark the end of what's set to be the worst quarter for the 10-year U.S. Treasury since the 1980s. The only other period with even worse total quarterly returns for the 10-year treasuries or their equivalents was the fourth quarter of 1931 during the Great Depression. The analysts at Deutsche Bank comes a day after a widely followed spread between the 2-year and 10-year yields briefly inverted for the first time since 2019, raising the possibility of a U.S. recession at some point. I had been talking about this in regards to my buying of Goldman Sachs. I said I would sell it if there was a meaningful inversion of the yield curve. The 2 and the 10-year, I think, is meaningful. It was brief. It may be a false alarm, but I still used it to take I think it was like a 1.3% gain. Just too many headwinds here, just too many headwinds, and a 2 and a 10-year inversion. That was enough for me to get rid of it.
Hey, so here, I'm going to interrupt you here because you already know what question I'm about to ask. But first, I want to say, hey, anytime that you're up on a stock and you feel like some headwinds are coming in, news is changing, the macroeconomic environment's changing, yeah, just go ahead, take your profit and be happy with it. But the question I want to ask you is because you mentioned the inverted yield curve. I've seen it on CNBC. I've seen it on Fox Business. I've seen it on Bloomberg. I've seen it on all the headlines about this inverted yield curve. Brandon, can you explain to a fourth grader what an inverted yield curve is and how it affects the markets? And how does that mean this is going to be a recession?
Are requiring a higher yield on a short-term bond or treasury because they expect headwinds. That's what it is. So there's a higher yield there was on the 2-year than there was on the 10-year, because generally we're almost always pretty bullish long-term on the American economy. But when we expect a recession in the near term, we're going to require higher yields for our investments on the short of the curve.
I like that explanation. Cool. Now, all right, so let's go ahead then. Now we got the inverted yield curve, and you sold Goldman Sachs because partly because of that. And and we're looking at this as, do you think it's a signal for recession?
I think it's a signal that people are afraid of a recession, which is obvious. I do think that there's a great possibility that there's going to be a recession fairly soon in the short term, within the next 1 to 2 years. I think it's going to happen. I think that's what we're headed for. In fact, I think that some people on the Federal Reserve are kind of hoping for it. And in a way, I don't blame them, because I'd rather get it over with. That's how the business cycle works. We boom and we bust, right? I would rather the bust not be great. If we get into an overheated economy, which we kind of already are, but if we keep going further and further and further higher with prices and everything like that, then that just means that they're going to have further to fall. So we need to put the brakes on it. If it costs us a short recession, and a recession doesn't have to be as painful as it was in 2008, 2009. It doesn't have to be 1970s style stagflation and recession in the 80s or anything like that. It could be just something that we're over with by the end of the year. That could happen. Now,
so you're looking more for like, so you're looking more for like a correction, but a deeper correction than just 10%. You're looking for an actual correction to set things back to proper PEs, proper multiples, proper actual pricing in all aspects, is what you're talking about.
What I'm thinking. And honestly, I was a little bit more bearish about this until the Biden administration announced that they're going to be releasing 1 million barrels of oil per day from the reserves for the next 6 months. And I think that other companies or countries are going to follow suit. So I think we'll see more than that. That's going to be around 180 million barrels total for the next 6 months. That doesn't make up completely for the 220 million barrels from Russia, but it's at least something, and we can get through it. But go ahead.
All right, so you're mentioning oil now, and 1 million barrels of oil, right? So we're no longer importing Russian oil, which is what the number out there is, 266 million barrels a year, right? That's the number that's been put out there that America has been taking in. Saudi Arabia has gone on. Everybody keeps I don't know why nobody, see, I follow oil. Nobody's mentioning that Saudi Arabia has had to shut down plants because of the Houthi rebels. I mean, guys, that's millions of barrels a day that can't be produced by Saudi Arabia. So America is not making up for the loss of Russia and the loss of Saudi Arabia. We're still at a net negative because Saudi Arabia can't get the Houthi rebels under control and get their plants protected, and we cut out Russia. So I mean, we're still in negative.
Yeah, we
It's,
are.
it's not going to make a dent. It's not going to make a dent in the oil.
It makes a one to make a little bit of a difference. I'm not shorting oil anytime soon here. The worst case scenario that some people were talking about were upwards of around $10 a gallon.
Oh yeah, it will stop that from happening. Yes.
Yeah. So we're not going to get there. I think it's going to be manageable. Let's remember that the R word, recession, can be scary, but it's just 2 consecutive quarters of declining GDP. That's that's something that we could be over with quickly, if you're long on stocks. So I'm not too concerned.
So I mean,
and I'm not saying we're not going to go into a deep recession. We might, but I don't think it's going to be anywhere near as bad as it was in the 1970s, because we've talked about that on the show. Maybe it was a year ago when we first started talking. I started talking about the possibility of 1970 style stagflation. I don't think we're going to get there.
Yeah, this just show here, guys. If you were listening to us and you were one of the 2 listeners when we first started, you heard us talk about inflation coming up and the possibility of higher inflation. We also covered the fact that even the Fed chairperson at that time, and my mind is drawing a blank.
It was Powell still then. It was still Powell when we started this show. Yellen was.
Thank you, Treasury. Yellen was Treasury. Yellen went on record as saying that we needed a GDP of 6.8, and we were not gonna, in order to pay for the bills that we were just passing, and we ended up with just like at 6.2 or 5.9, and so we were far short of what we needed to pay for these things, based on the estimates given by the Congressional Budget Office. And so we were already in the hole. We were putting ourselves in the hole then. Inflation was starting to grow and grow and grow then. That put us on a higher pace for inflation. Then Russia, Ukraine, and oil put us on an even faster pace on top of that. It was just one thing after another, after another, after another, and nobody was doing anything to stop it. And even you said on the show last year that, I think that, by the time we start doing things to stop it, I mean, it's going to be out of control, but eventually we will take the correct action. And it's taken too long, too much. Yeah. The effect on the economy is already there. And the people who hurt the most are the poor.
And I'm not giving a ringing endorsement of the stock market right now. I think the stock market has not priced in how bad things can get. So, I mean, there are still some exciting opportunities in the stock market right now. But still, I think that we're going to go much lower at this year. I think it's going to be a much tougher time this year than what a lot of people are expecting. I mean, we'll talk about this a little bit more later in the podcast, probably actually really in just a few minutes. But the RH CEO, Gary Friedman, said that, just a couple of years ago, the price of a container had doubled. And he didn't have the numbers in front of him to say what they went to just recently, but he said that what the containers for him have cost now makes that rise that happened a couple of years ago look very nice. So
right, it's almost to the point where instead of building things in China, we might go back to where we were pre-moving to China and build things in Mexico again.
Yeah, it's possible. Who knows? One thing that Biden said when he was talking about the oil situation, he said something that raised my eyebrows. He said, "This record release will provide a historic amount of supply to serve as a bridge until the end of the year when domestic production ramps up." So does he know something we don't know? Does he know that domestic oil companies are going to ramp up their production?
Well, remember when I went and I dug in detail about what happened to the rig count during that time and why did it drop with Biden, the administration took over and everything. And I started looking into it, and I found out that when Biden administration took over, they canceled a lot of the permits that were put in place that were waiting to be approved by all these oil companies, and said no. And that's why the rig count dropped drastically during that time.
And he still got a lot of permits to approve.
Yeah, and
That's
he,
been
you know,
reported, and that could be a factor in this, that he ramps up his approval of these permits, and the domestic supply can start going back up again.
and that would be great for the U.S. consumer. That would be great for U.S. jobs. That would be great for a lot of reasons. But I mean, why you? I don't want to be political, but it seemed to me, based off the research I did, and if anybody wants to know my research, I could share it with you. DM us, at Chinchilla Picking. But based on the research I did, is he caused the problem, and now he wants to offer the solution.
Yep, exactly.
Which I'm just happy we're at the solution, so the economy can grow and I can make money on my stocks, right?
Yeah.
So let's talk about a stock that you had owned. I don't know if you currently own anymore.
I still own it.
Restoration Hardware. What happened on this earnings call that was such a fiasco that caused Brandon to send me lots of text messages on that day? Go ahead, man.
Okay, so you and I just had a discussion of macroeconomic policy, and we talk, and all of this is based on theory. There's history involved in it and stuff like that, charts, data, all that good stuff, but nobody can tell exactly what's going to happen. I'm not Miss Cleo. I don't have a crystal ball in front of me. I'm not telling you to call my hotline so I can tell you the future and read your palms. That's not possible. I can't do it. So there's a time and a place for everything. Me and you talking about this on this show is fine. This is not an earnings call. This is not an earnings call where you stick to the facts and say, hey, we had a great year. We grew revenue 32%. And then you talk about like how you think Janet Yellen's wrong and Jerome Powell's behind the 8 ball. And then you completely overshadow all of the positives that you just told us by a dreary negative economic outlook that may not even come to fruition.
Is that what happened? Because I did not hear the call.
Yes.
Wow.
Okay. So
wow.
positive.
Wow. And he thought that was going to go over well with investors, huh?
He quoted The Big Short.
Which, by the way, I love, but still, I wouldn't quote it in the earnings call.
And there's not a single thing that this guy said that I did not agree with. Not a single thing. It's just not the time to do it. Okay. So positives were overshadowed by the remarks of the CEO about the macroeconomic situation. He blamed the decline in demand on Ukraine, which makes a little sense to me. There was a 10 to 12% decline in demand in the fourth quarter. In the fourth quarter. He blamed it on Ukraine and Russia. I understand maybe blaming it on oil prices, but even then, you're catering to a crowd of people that are the last to be hit hard by oil prices. Most of them are driving electric cars, anyways.
Yep.
So they're still paying higher prices of groceries, but these people can afford it. They're buying $10,000 couches.
But this was quarter 4, man. Like Russia-Ukraine thing wasn't major news at that time, and there was no invasion at that time in quarter 4. It was just Russia had troops at the border then, and that was it.
For them, it started right at the end. For their fourth quarter, it started right, but it was way too early to blame it on that. I would have totally understood if you say, hey, look, we're only expecting a 7 to 8% increase in revenue this year. We had a 32% increase of revenue over last year. And then prior to that was a 40 some odd percent increase because we had crazy comparables because of COVID and all that stuff. And hey, look, we pulled forward a lot of demand because there was a hot housing market. People were working from home. They had to furnish their houses, and all this demand got pulled forward. And we're going to go ahead and combat that by expanding into Europe, by going into Paris, Brussels, and London. I would have understood. I completely understand that. And I think the market would have reacted a lot less crazy had you just said those words. But I don't understand the whole blaming it on Ukraine and Russia. Even if you say the oil prices, look, Nike, Williams-Sonoma, these are brands that cater to customers that are much more sensitive to the rise and hike in oil prices, and they had great quarters. So
I don't know, man. Have you gone to Williams-Sonoma and just got like a coffee maker? It's like $500.
Let's just use Nike as the example. Nike had a great quarter.
You want that spatula? That's $150.
Now, I understand being negative on the inventory levels. I mean, Traeger's it's a grill company. This was mentioned on the conference call too. They said the same thing about inventory levels in the supply chain. They're not going to get back to normal by the end of this year. They said the same thing. I get it. It's an industry-wide situation with the supply chain and inflation's affecting everybody. But it was just weird to say the Ukraine-Russia thing. I didn't buy that at all. Kind of sounded like an excuse.
Overall, so besides the missteps in the conference call, how are the actual microeconomics, the actual numbers and fundamentals?
So revenue increased 32%. That was pretty good increase there. It was a record year for revenue again for RH.
That's a good increase for an established company.
Yeah, it is. And they're saying, okay, they also gave guidance on their new investments in Europe. Like as I said, they're moving to London and they're moving to Paris and to Brussels, and there's a few others in there as well. They said they know that brand recognition in Europe is high, but they don't have access to the brand because there were no RHs in Europe at that point. These new investments, they say, will create an additional $5 to $6 billion in the United States and globally $20 to $25 billion by expanding into Europe. That's positive, but nobody's focusing on that right now because he quoted The Big Short and he said, I don't want to scare everybody, but I talk about this. And like there's a scene in The Big Short where everybody is in the ballroom and that one guy on his BlackBerry goes, can I ask a question, sir? In 20 minutes that you've been talking, your stock is down like 55%. And everybody runs out of the room. He quoted, he said that. And then he said, I've never been more excited, but I've never been more uncertain.
Wow, that was the word there, uncertain.
Yeah.
Yeah, you don't want to hear that from a CEO.
And he says,
wow.
Is it your view that these purchases are merely being deferred, talking about the 12% demand decrease, or is there a possibility that prices have raised so significantly that the customer is now responding to that? Gary says, what do you think? I don't know. I mean, it could be a little bit of everything. It could be a distraction from the war. It could be many things, Michael. How do you not have a survey that tells you, we all survey our customers in retail.
Constantly.
we do. We have and there's third parties that go out and try to figure out what's on the consumer's mind. We have consumer sentiment. You should know, at least have some sort of idea of what's going through your customer's mind and why demand has decreased. And it's probably not Ukraine, Russia. Okay. Yep. I wasn't saying if I needed a new couch, I'm not going to think, wow, Russia just invaded Ukraine. I better not buy that today.
Yeah.
It makes sense.
Yeah. And I will say this, that the wider consumer sentiment survey that went out by, in general, and it was reported on Friday, was very low.
Yeah.
People are very negative about the economy, but that was a general economy as a whole. That wasn't just about restoration of hardware or retail. And I'm very negative on retail to begin with right now.
That wasn't now. That was a month ago.
Yeah.
When they were still in their fourth quarter, when the Russia-Ukraine thing was just building up. It was so early. Now I could understand people saying, well, I think oil prices are going to go crazy. I think
I need to save some money.
I understand it now because of how the situation has devolved really, but then not so much.
Yep. 100% agree. So saying all that, are you buying more? Are you holding?
It's not a fireside chat. I'm not having a conversation with Gary over a beer at a bar. It's an earnings call.
Yeah, and you're expecting the earnings call to be more professional, stick to the facts, stick to the points, give some guidance about how it's going to look. Don't just say, I don't know, I'm uncertain. That's not what you want to hear from a CEO, the guy leading the company. You don't want to hear uncertainty. You want to say, if you're going to have some headwinds, I want to hear you say, I'm going to have some headwinds.
Yeah.
We're gonna have some trouble here, but this is what we're doing about it. Like, offer a solution, give us something. Don't just sit there and say, oh, I don't know, I'm uncertain. What do you think, Bob? Who cares what Bob thinks? I want to know what you think. You're the one leading the ship here. I want to hear from you, man.
Yeah, exactly. Now, some people are comparing this because they're coming out with RH Contemporary, a new furniture line. And right when RH Modern was being released, a lot of investment was being put into that. The stock went from somewhere around $120 down to like $24, $25 over the course of a couple of months. That's comparing apples to oranges, though. In 2018, RH had an operating margin of 11.4%. Currently, they've got a 26% operating margin on all fronts. The balance sheet is better. Their cash flow is so much better than it was in 2018. They're so much in a better position right now than they were then. And like I said, they're initiating a global expansion, getting ready to enter into London, Paris, and Brussels, amongst more in Europe. And I think those are perfect cities for them to be in. Really, it is. But after all that, they announced a 3-for-1 stock split.
People like stock splits, especially of solid companies that have good fundamentals. You want the stock split means they expect to be growing. They expect some growth. They expect the stock to move up. How much of a drop do you say it took today?
What was it, 13%? Oh, let me
13%. So I mean, if it's down 13% right now, if you firmly believe in the fundamentals in this company, I would buy in. Now I'm not,
so
because I'm not in retail, but if you did, I would.
So yesterday was the drop of 13%. Today it took a little bit of more of a haircut, and it went down about another 2 to 3% today. Like, if you're long here, yes, I would buy it. I think the global expansion is great. It makes no sense to me that they're doing a Gulfstream jet to fly around. I mean, you're competing with commercial airlines on oil, and you can't compete with them on oil. They've signed their contracts months ago. They're paying a better price for oil than you are, and you're competing with other companies that have been in that game of chartering private jets for a lot longer than you have. To do this makes no sense, but it's such a small portion of their revenue that it doesn't really make much of a difference to me. What makes a difference is London, Paris, and Brussels. That's what
I think Europe's oversaturated with for I don't know.
Well, high maybe, but I mean, it's just taking another 1% of that chunk.
I mean, come on, it's Paris, dude. I mean, yes, your restoration hardware, but Paris, that's seen as like Milan as one of the capitals of fashion. New York, Paris, and Milan. I mean, you're going to go into Paris and sell American contemporary to Parisians? Come on.
I think it'll work. I think London will be great, and I think Brussels will be great too. I think Paris is a perfect spot for it. I think it fits right in line with the RH culture. It's very high end.
Hey, again, I'm not buying retail right now. That's where I stand. But I still have asked you. I've asked you twice now. All right, this is my third time asking you. Is this a buy? Is this a sell? Is this a hold? You're buying. So are you adding to your position?
I am hesitant to call buys right now with the stock market.
So you're saying this is a hold then? You're saying this is a hold?
No, I'd still say this is a buy, even though I'm saying I'm hesitant. I say it's a buy because, I mean, I don't know what's going to come in the next couple of months. It's very hard for me to tell right now. A week ago, I was positive again, but we've already recovered from the negativity that we had as far as the stock market and NASDAQ goes. So I'm a little hesitant to announce buys here, but yeah, I think it's a buy. If you're going to hold it and you don't need the money for the next year, yeah, buy it for sure.
There you go. I'm not hesitant to announce buys. Apple's a buy right now. Buy Apple.
I don't think that
put that on record.
Listen, RH is not Apple nearing $500. It's not Tesla nearing $1,000. It's not Amazon, or Google at those levels. This is a $320 some odd stock right now. So a 3-for-1 stock split makes no sense to me because retail investors can't afford it already. You can already afford, full shares. RH at 720 last year, a 3-for-1 stock split back then, fine. But now I don't get it. Your stock's already shaved off enough to where it's affordable for everybody. So
there you go, man.
GameStop's doing a
hold on. All right, hold on. Are we transitioning to GameStop? Because if we are, I want to lead the way here on this one.
Lead it.
Good.
Take
all right. So we're transitioning to GameStop.
Say one more thing, okay? Because we just talked about a call that I made that could be perceived as bad. But look what happened to Robinhood today, okay? It was like another 7% drop. I told you this back in December when the stock was trading at $27.
And we both agreed on that.
Yeah.
All right. So GameStop, guys. GameStop. Yes, the apes are crazy. I don't understand this. I mean, I've been wrong a lot on GameStop because I think it's at most a $20 stock. I don't understand why it's so high. The valuation's overpriced. I want to mention, I mean, they're increasing their shares to 1 billion from 300 million. This is planned stock split they're doing, right? Anytime you're increasing your shares like that, and you've had loss after loss after loss. Let me go over some losses. Ready? Q2 of 2021, negative 76 cents a share loss. Q3 2021, negative $1.39 a share loss.
Per share, do the math on how many shares are outstanding.
Yeah.
Try to figure out how much money they've lost is crazy.
Hold it. Q4 2021, it grows again, negative $1.86 a share. Their losses are getting bigger, and yet their value, people are still holding. I don't understand it.
So the only reason why their losses look smaller prior to this is because they were selling shares onto the market when the apes were forcing the short squeeze, and they were making money that way.
Yeah, they were making money off the stocks, off stock. I mean, come on, guys. This is, I mean, this kind of company back in 2004, when I was first messing around with trading stock, would have been investigated for being a shell company, just for moving money around, liquid, before Bitcoin was around to move money around. That's all this is. And it's working for some people. Some people have made a lot of money off of it. Congrats to them. I'm not going anywhere near this. This is ridiculous. So in January this year, their debt to asset ratio though was 54%, which, it's over half. It's still not bad. I don't understand that. They have a profit margin of 17.84%. I mean, that's still, it's anything. I don't get. Yeah, exactly. They're not making the numbers that they need to make. And when the CEO, this great guy that everybody loves, bought more shares a month ago, followed all the rules, and then a month later says, "Hey, we're doing a stock split," knowing the stock's gonna jump. I mean, come on, guys. He's playing you. He's making his money. He's gonna get out of here with lots of money made. He sold shares. I covered on the show all the money he made off of selling stock, and the previous CEO, how much money he made off of selling stock. Because of you guys over there pumping up the stock, these CEOs are making hundreds of millions of dollars selling stock, making money off of you. And you're meant to be all about bring down the rich guy. Look what you're doing. You're making them richer. Sorry, that's my soapbox on GameStop.
January 19th, 2024, $20 strike price put is $353. You think it's worth it?
Wow, really?
Yeah.
Wow.
It's possible. I might do it tomorrow. I don't know. We'll see. It is a long time to hold a option in such a volatile security. But to me, saying that GameStop is going to be a penny stock was just as easy as saying that Robinhood stock was going to decline. This is the easiest call I think I'm ever going to make on this show.
That's the premium on this, 353.
353 on a put, $20 put. January 19th, 2024. I don't know. I mean, because I think it's going to be a penny stock. In fact, it's if we go into a recession that goes deep, my bottom will be when GameStop and the rest of the meme stocks become penny stocks. Less than $5 a share. That'll be my bottom. That's when I say, okay, we bottom. We got the froth out of the market. GameStop is now where it should be. Bed Bath and Beyond, AMC, they're all where they should be valuation wise, because valuation in the long term always matters. And the froth leaves the stock market. That's when you can call a bottom.
Yeah. You know what? I at least like the AMC CEO, because he has gone on, and I've said this quote time and time again on the show. He has gone on and said, "Do not buy our stock." At least he's honest. Yeah. Cohen's over here saying, "Oh yeah, buy tons." So yeah, a month ago I just took some options out and bought some more. I need you guys to buy some more so I could sell it and make money. I mean, come on, man.
A lot of people lose a lot of money, and it's sad.
Yeah, it is what it is, man.
This is the pets.com of our generation.
Pets.com, right? Oh, wow. Woo. I remember that. That's because I'm old. All right.
I was in high school, but I still remember it because I was a dork.
Yeah, so GameStop, that's ridiculous. I can't believe they're doing a stock split. But you know who I can believe is doing a stock split is Tesla.
Again.
Again, yes, another stock split. And I, you know what, I'm waiting for it to go below 1,000, and then I would probably buy in.
Those
Drops below 1,000, I would buy in.
rallies on that stock are crazy. I mean, it starts to drop, it starts to go, and then all of a sudden the dip buyers pick and it goes right back up.
Yeah, but they're building a plant in Germany now.
Yep.
Right there, right next to the Intel chip maker plant that's also going in Germany. Yeah, Germany's getting a lot of plants being built there. Their economy is going to be doing well. I'm just saying, if Intel, Nvidia, Tesla are all building plants in Germany, I mean we got to think about how important that economy is to Europe. Number one. Number two, is Tesla going to build a plant in Ohio now, right next to the Intel plant over here? Because they need all those chips to run their cars.
We need a lot more than what we have right now.
Right. Even with Intel building their plants, that's still not enough. It's not going to be near enough.
That's one of the reasons why I think we're different now in this situation than we were in the 1970s. In the 1970s, during stagflation, unemployment was high because jobs weren't there. They weren't available. Right now, we have an employment shortage. We've got a job shortage in this country. That could save us. Number two, we are so much more productive with so much more technology on our side right now that puts us on such a better footing than we were in the 1970s. If we have any kind of recession that's deep, it'll be more like 2008, 2009, where we have sort of an explosion and then we recover from it, whereas the 1970s and early 80s was a slow burn.
It was a slow burn.
Painful.
And I mean, if we're gonna have a recession, I would welcome the sharp V. That way I can make money off of it.
Yeah, I'm excited for that. If
make money on the way down, make money on the way up.
Yeah, I would love if everything just always went up. That would be great to a certain extent, as long as there was no crash on the other side. But we know how this ends. We know how the GameStops and the Bed Bath and Beyond ends. We know how housing market can turn into something much more drastic. We've lived through that. We lived through the .com, burst. Hey, we'll live through this too if it happens, if there is a recession. I think there's a lot, there's some weird things going on because the people that are negative are often more negative than they should be.
So, yeah, but the negative people never get called out either for being wrong. Like, oh, we're going to get a recession this year, and nobody ever says anything when nothing happens.
Yeah.
But they say it every year, and then when we finally do, they're like, look, I was right.
Yeah.
Well, I mean, you say it every year. I'm not buying GameStop on the stock split. I'm not interested in it at all. I'm definitely eyeing Tesla, but I'm waiting for a dip down because I think the broader market is going to take a dip down and they will take Tesla down with it. And when Tesla reaches a good price point for me, I will get in. I thank you. I want to come on here and thank Brandon for that Meta. He forced me to buy Meta a couple of weeks ago on the show. We didn't force me, but he convinced me to go ahead and start putting the 30% in. And so I did. And then it jumped way up and it's still going up. I'm holding my position and I'm going to hold that position for a while. But, I mean, that just goes to show you sometimes, guys, you got to do what is the right thing to do. Like if you believe in the company, and this is what we talked about with Meta that day, was if you believe in the company, shouldn't you at least put 30% in now, wait for it to go down, put 30 more percent, wait for it to go down, put 30 more percent if you think it's going to go down in the short term. That way you build your position as it goes down because you believe in the long term of the company. And that's what I did. I put that 30% of what I was going to plan on putting in down, and then it just jumped up on me.
Yeah, when companies like that reach such a value, it's really hard to tell when they're going to be valued upwards again and when sentiment will change. I still don't think that sentiment has changed completely for the bullish on Facebook. So I think it's got, or Meta, whatever you want to call it, I think it's got more room to run over the next year.
Hey, I'm up over 20%, dude, in 2 weeks.
Yeah. So yeah, you're good, right? So that happened just like that, right?
Yeah.
And nobody 2 weeks ago was telling you that was going to happen. You turn on CNBC Nobody on CNBC was going to tell you that in 2 weeks it was going to be up 20%.
No, I even thought it was going lower, and I was wrong.
I owned Meta, and I couldn't tell you it was going to be up 20% in 2 weeks. I just knew that it was undervalued. And when you're buying a stock that's undervalued and you're not using technicals, you're not using charts, then sometimes you just have to take the dive.
Yep. A lot of people don't understand that. They see people out there. Well, they hear, and they think they see people out there who are making. I made $1 million last month with $1,000, and I day traded it. I mean, like,
don't confuse luck with skill.
And I'm just like, guys, you could be a multimillionaire and have your financial security by just hitting these base hits all the time, investing for the long term. You'll be just fine. You'll be surprised how fast everything grows. I mean, Brandon and I have a mutual acquaintance of mine, a friend of Brandon's, that's been following us since the old Facebook group page we had for a long time ago now. And this guy's got diamond hands like you wouldn't believe. And I know he's doing well.
Yeah.
I know he's doing well.
He's fine. Even with the craziness this year, he's good. Sometimes you just have to have patience. Patience pays in the market. It really does.
Yep.
Over the long term.
Yes, it does. And it doesn't matter, guys, if you're right now listening to this and you're 40 years old or you're 20 years old, it doesn't, what I always said, if you take $1,000 and you do 5% a week, in 4 years, you'd be doing just fine. Just fine. Yeah. I mean, you don't need to rush it. Take your time, do your research, man. It's crazy. It's crazy what you can see on some of these forms that get submitted and people overlook about companies, and you could find that diamond in the rough very easily. Yep. Patience.
Exactly. Now I do want to say this. Oh, go ahead.
Actually, I was getting ready to wrap up. Did you have something?
No, actually, I was going to give you my final thought. So you go ahead.
Go ahead. Final thought.
Okay.
Final thought from Brandon. See, guys, we really don't script this, and this is proof of that.
We are
final
completely unprepared. Okay, so last week I told you that RH had a good setup going into earnings. At the time, actually, in my defense, it did. And it ran about 6% before the earnings call. And during the earnings call, the thing actually jumped up to like, what was it, 390 or something like that. It actually went up a little bit more. So it did have a good run going into earnings. I wish we would have had this podcast on Tuesday, but due to time constraints and other responsibilities and things like that, I couldn't do it. Because if it was on Tuesday and you weren't long on RH, you were trying to make a short-term trade out of it, I would have told you to sell. Now, long, I would have told you to hold because I'm holding. But it is often a bad omen going into earnings that you have a run up on a stock, because that means that expectations could be set too high. Now, as of last week, RH was in a downtrend, and it's still a long-term downtrend, right? But we had that 5 to 6% rise going into earnings. I would have told you to sell. So just keep that in mind if you're trying to do a trade based on earnings. A stock going down into earnings, as long as it's a good company with good fundamentals, a stock going down into earnings is often a good omen for what's going to happen after earnings, while the rise going into earnings is often a bad omen.
Yep. I agree. I like it. Final thought from me is I'm waiting for Tesla. I believe there's going to be a broader downturn in the market soon, and I'm going to be buying in once Tesla drops down to a more suitable price range for me, because I want to make money off it. I don't want to just buy something that is at a premium price, but I think it will go up because of the stock split and a few other issues. Apple's a buy. I had a price, I think it was like 6 months ago, I said, maybe a 180 I would sell. Now I wouldn't even sell 180 now. It's going to keep going up. Their subscription service under leasing is something for the future where they're trying to go with this. You could lease Macs, you could lease phones, different things, different devices. It's a good program. It's going to make money. So, Apple's buy.
you may have some false alarm headwinds when people start to look more into valuations. The S&P 500 is trading at a price to earnings ratio of around 20. I think Apple's around 28. And so people may look at that and mistakenly think that it's too expensive to pay for Apple right now. So you may have some short-term headwinds, but with Apple, you can just buy the stock and put it away and forget it for the rest of your life.
Yep. Yep. I agree. All right, guys. That's our show for tonight. As always, we hope we've been entertaining, educational, and uplifting because we want everyone to make money. Have a good night.
Good night.